So case one, logging business in North Vancouver Island. Background information, Anjur Patel, graduate from Bachelor of Commerce program, partner with Lucas Laga, indigenous entrepreneur from Wako community to establish Twagatenberg Hall. They both use their inheritance to fund the startup. The company is based on Port Alice, a small town in northern coast of Vancouver Island, British Columbia. Their vision is to build a successful, sustainable logging business that honors indigenous traditions while contributing to the local economy. Both partners hope to start families once the business achieve financial stability. Now, the owners of company, Anjur and Lucas, manage strategic vision and daily operation. The company employs 30 workers, many of whom represent a second generation of their family to work in the local forestry industry. Company prioritize worker safety, maintaining high standards, and achieve safe certification from British Columbia Forest Society Council. That's the information about the company. The only thing that you can take here is what might be their strategy and what were their vision, and that's all. And the requirements, what they want is to achieve income so they can grow their family. So now industry and operation. In British Columbia, 95% of the land is crown owned, meaning the logging activities are regulated. Company operates as stump to dump contracts, storing logs in the dry land sorting facility and shipping them to miles, mostly in southeastern Vancouver Island. Company generates revenue primarily through the log sales. Currently, they're selling 20,000 cubic meters logs per year. Average price per cubic meter is 175. The business incurs various operational costs, harvesting that much, reading, road building and maintenance that much, hauling and transportation that much, logging and loading and scaling that much, fuel and lubricants that much, administrative cost, equipment repair, maintenance that much, insurance, depreciation, and interest expenses. The variable cost per cubic meter includes harvesting. So the variable cost is the harvesting. Then we have the hauling. That will be a hauling here and transportation, logging, which is this one, and scaling, and fuel and lubricants, obviously, that will be the variable cost. So those who 1, 2, 3, 4 are the variable costs. What's happened with the other one? The remaining costs are fixed costs. Which are the remaining costs? Road building and maintenance, those are fixed costs. As you can see, then administrative costs and all the other costs are fixed cost. Okay, so company needs your help with the following. Relevant financial data is provided, as you can see. In addition, insights can be drawn from the balance sheet with a pending say. So the other thing that you have available is this balance sheet. So now the balance sheet, what you can do is, for those of you who are smart, you just copy it and paste it in the Excel spreadsheet, and you should be able to work it with it. That would be one way to do it. Just copy and paste it, or just transfer everything in the Excel spreadsheet, and then you can easily do whatever you do. You can see the cash, you can see receivables, inventory, other current assets, total current assets, fixed assets, this and this, and there's depreciation. You have the depreciation here. Other assets, total assets, liability, current liability, that much. You can see, you can easily see that the current ratio will be most likely below 1. Why? Because you don't have much current assets to cover your current liabilities right there. Then you're going to have long-term liabilities, this and this. Long-term liabilities, that total liabilities, that much. And now we have equity. And equity, what's in equity? That probably the investment and retained earnings. So since clearly this is not the first year of operation, will be $1 million. Luckily, we don't know previous retained earnings, so that's fine. So let's go back to our information. First thing that you have to do, group one, what you have to do is to, since the company needs your help, let's see what you can help them with. First, calculate how much cubic meter logs must be sold to break even. How are we going to get the break even? Obviously, you need the sales price, which you have it. Sales price 175. You get the 175 per cubic meter. You know how many cubic meters was per year. Then you're gonna have annual cost, so you can easily stay with the total and calculate the total, or either go with the cubic cost, variable cost per cubic meter. You can calculate those one. There's no problem. You have that information. Having my those in total, so divided by 20,000 is going to give you per cubic meter. You can come up with the variable cost per cubic meter, sales price per cubic meter, contribution margin per cubic meter, percentage. So you can calculate this break even without problem. Next thing that you have to do, first one. So first calculation the break even point. And comment on the break-even point. Explain what the break-even point is. What the break-even point is, and can make a conclusion how much is the break-even point. Next thing, number two will be what's going to happen if 10% we have 10% increase in the log price and 10% decrease. So you have to do the 10% increase and 10% decrease on the log price and comment on break even, how the break even changes if those two happen. The next thing that you have to do, how many cubic meters, so what's the number of the cubic meter quantity for cubic meter you have to achieve to meet the target sales target of $500,000. That's what you have to do here. So you have 1, 2, 3 calculation, and then you need explanations on each of those. Calculation is one part, explanation the second part, under each of those three. Next one. In order to this company ordered commercial truck from US with a base price of 300,000 US dollars. The exchange rate is that much, additional costs included. Brokerage fee 2,000, shipping cost 14,000, shipping insurance that much, commercial vehicle permit 3,000 annually, US export fee exercise tax is 700, GST 5%, PST 7% applied to the base purchase price, certification 29,500, legal consulting fee that much, initial maintenance, safety and maintenance 2,000, additional commercial insurance of 22,000. That's an annual commercial insurance of 22,000. Custom paint job to match the company brand. Branding 3,200. The driver training cost 3,000. Advanced GPS navigation system cost of 4,500. So out of those price, what you have to understand is only this price is in US dollars. Everything else is Canadian dollars. So only the base price you have to convert to Canadian dollars, and then you have to include all the cost which is related to the truck, commercial truck, to make it available to perform the purpose that they having for. The truck, now the next information, the truck has estimated useful life of 10 years, which the salvage value 50,000 at the end of the 10th year. What you have to do, you have to use the straight line depreciation. And TC want you to, number 4 now, calculate. So calculate annual depreciation expense for the first and second year and provide them, provide explanation on how the truck purchase will affect the financial statements. So what you have to do is find the purchase price first. Actually, you have the base price. So the other cost and come with the cost of the truck. How much is the cost of the truck? Then deduct the salvage value, get the number of the years, calculate the straight line depreciation for the first and the second year, which is not going to change, obviously. And then once you do that, by including and excluding costs, what I want you to do is for everything that you have to include, explain why. Explain what you have to include. For everything that you don't have to include, explain why you don't have to include. So both of those, I want explanation so I can understand. Do you understand which has to be included, which one not to be included? That's first time. Second, come up with the straight line depreciation. Explain what the straight line depreciation is and calculate the first and second year. Then, what will be the effect? Number 5 will be, so first will be the cost, calculating cost is explanation of the include. 5 will be explanation on effect on straight line depreciation. How this going to affect the financial statements. So to fund that's done with the truck. Now to fund the truck, we have two options. One option is to adding the third partner, this person, a local businessman who will contribute amount equal to the truck cost. So he's gonna pay those. How much was that? Whatever cost you come up with. It's not 300. That's only initial, plus something else. He's gonna put whatever you ask him to give you. However, he will gain ownership and decision-making rights. Second, taking the bank loan, 8% interest, and you have to maintain debt to equity ratio 1:1. And you have to secure it with the assets, and it has to be paid over 10 years. So what you have to do, you have to evaluate both options. First, before you start calculation, but even you can do the calculation, but you have to do qualitative, that will be the qualitative analysis on pros and cons. First, having partner. Second, getting bank loan. Three each. Three pros, three cons for those two options. Having partner and having the interest. What's the benefits? What's the drawbacks? Then, once you do that, assess the financial implication. What's going to happen if the person give you a loan? Actually, if the person put the money and become a partner, what's going to be effect on the company? Which item on the balance sheet is going to change, and which items on the balance sheet is going to change. And the next one is if you get the loan, what will be the implication of financial statements? What's going to change there? Obviously, there will be increase in the expenses. So those increased expenses, you have to be able to identify how much is that. And that's we're done. We're done with this. Then you can do what else you can do here, once you do the qualitative analysis on the pros and cons, you can conclude, that will be number 7, let's say number 7, that conclude on which options will be you gonna recommend or provide a recommendation on should I add partner or get the loan. Either one, it's working as long as you can define it and explain it and discuss it and justify it. Next one. This company consider expanding its business to Washington State in US due to the proximity approached by the local bank for the loan needed to the expansion. The bank is interested in company financial statements. You will review the income statement, balance sheet, and ratios. To understand the financial health, the bank will require 3-year income statements to forecast TCL expected revenue, expenses, profitability over the next 2 years. You are welcome to make any necessary assumptions. Any assumptions should be stated clearly. John and Lucas are seeking to your system with this matter. They're wondering if there are any ethical concerns with the expansion. So now what I want you to do here is first, ratios. Current ratio, explain what the current ratio, how is calculated. Second, debt to equity ratio. Explain what's that ratio about, how it's calculated based on the current situation. Then get the return on assets. Return on assets, you have to prepare the income statement first in order to get it. How are you going to prepare the income statement? You already have the revenue. You have the revenue. Get the all the variable cost treated as a cost of goods sold. Come up with the gross margin, everything fixed cost treated as operating expenses. Now, once you're doing the operating expenses, do this one, combined administrative cost, equipment repair, and insurance, put it as an operating cost. Come up with the operating income. After that, I want you to show separately depreciation as expense and interest as expense, and then get the net income from operations before taxes. And that's all. That's why you have to do. Now, why you need to do this? Because from that point, you're going to get return on assets. You need the income to get the return on assets. Once you get those three ratio, explain the ratio, explain how it's calculated and calculated. You can explain what that means to the company, debt to equity current ratio, return on assets. And then I want you to prepare, next one will be number 9, will be prepare the 3 years income statement forecast. So what you're going to do on the income statement forecast that you have to prepare, once you prepare here the income statement, right, I want you to go with, you can choose which one you want to go. Do you want to go with the 10% increase in the sales price on the average price? If you want to go that's totally fine with me. And you can incorporate that 10% to be increased in the next 3 years. You can go with that direction. You can decide to go something else, or you can decide to go with the target profit with 500 next first year, and the next 2 years to have a 10% increase of the login price. It's up to you, whatever you decide. But whatever you decide with on this one, you have to state it clearly. If you make any assumptions, state it clearly. Then the next thing that you have to, that's for the revenue. For the expenses, I want you to consider that we already have the truck because the truck is ordered. So what you have to incorporate here, you have to show the change in the depreciation. That's why I want you to show the depreciation on one side and adding depreciation, which coming here from the straight line, right? And that's what I want you to do. Now, the last thing that you can do if you want, that's optional. That's not requirement. That's optional. If you decide here from this scenario, from this paragraph, this decision, if you decide to go with the bank loan, you can incorporate the interest expense. So adding more interest in the next 2 years, 3 years, sorry, next 2 years. But that's too many conditions here. So for that one, if you want to go that direction, go that direction. But again, clearly state the assumption. So say in our forecast for the first year, we're assuming that the company reached the net income of $500,000. And after that, the second and third year, the login sales price increased with 10%. We also incorporating the purchase of the truck and increase the amortization, depreciation expense for the truck. And if you want, we also anticipate that the company is going to get the bank loan for the purchase of the truck, and it's going to have to pay 8% on the bank loan for the next 3 years. And incorporate those one. Now, the ethical problem, the ethical concern, so that with the income statement forecast, once you do the state, then comment to the calculation and then comment on the numbers. What did you calculate? How you calculate it? And what's the results? Now, number 10 will be your ethical problem. If you see anything ethical here, go for it. First, we have the expansion of the US, right? We have here indigenous involvement. So think about this. Also, we have a truck, which uh, if you forget to do the forecast, if you on the assumptions, if you forget to incorporate depreciation, that's going to change the numbers. That's going to increase your income if you forget to do the depreciation expense. So there's a little bit ethical component. Think about it and discuss it here if you think that you have to discuss something here. Then next thing, the management has identified the following internal control issues. So certain purchase orders are not linked to the related project in the system. Warehouse inventory is disorganized, leading to inefficiency, incidents of crucial spare parts being misplaced in inaccessible shelves have occurred. Although no thieves have been reported, management is concerned and seeking a way to prevent a thief in the future. The recent phishing scam led to 1,500 loss after co-op student was tricked via WhatsApp. She received a message from someone posting as Lucas, urging her to buy a gift card from Best Buy and sending them to him the numbers urgently. The message claimed Lucas needs them to gift card to some customers or ongoing meeting. Now you have to the management seeking your recommendation to improve the internal control, inventory management, safeguarding against thief and cyber fraud. So you have 1, 2, 3 problems here. For those for the internal, that's your internal control issue. On those I want you to have 3 discussions here. One is for each of those bullet points is a problem. Identify the problem, discuss the problem, solve the problem. Next one, identify the problem, discuss the problem, solve the problem. Next one, identify the problem, discuss the problem, solve the problem. Which one of the internal control is affected from all the 5 elements that you have the internal control? Identify those discuss it, recommend course of action, fix the problem. That's internal control. Then the last, I think that's the last one. Or maybe not. So then we're having this forward-thinking organization, exploring participation of Cleaning BC Better Building Program. Initiative aims to reduce the greenhouse gas emission, energy cost, business, energy efficiency building upgrades. This is committed to sustainability cost-saving measures and led to the proposal several upgrades in their office building. First one is heat pump system for $150,000. Description is the model. A modern heat pump system that provides efficiency, heating, and cooling, significantly reducing the reliance on traditional HVAC system. And insulation improvement, cost of $50,000, enhancing the building insulation to prevent the heat loss during the winter and maintain cooler temperature in the summer, leading to overall energy saving. And energy study, 20,000 covered. This one is covered by the Clean BC, so that's not going to be cost for the company because it's completely covered from BC. Comprehensive energy study to assess the current energy usage and identify further opportunities for energy efficiency. This study is fully funded for the Clean BC program, so that's not at the cost of the company. Estimated annual benefits, energy saving about $20,400. This estimation based on the reduced energy consumption due to the new threat, a heat pump system and improved insulation. Now, the Clean BC Better Building Program provides rebates for energy efficient upgrades based on the certain criteria. The owners know that the rebates should be calculated as a percentage of the total eligible project cost or based on specific criteria such as amount of the greenhouse gas emission. Assuming that 50% rebate is 50% of the total cost. So what's the total cost? Obviously, 150 and 50, that's $200,000. You're going to get 50%, so $100,000 on the insulation program. And Julie and Lucas want you to help them to calculate the payback method. So if $100,000 and you're getting 20,000 saving, how many years going to take you to get the money back? Obviously, uh, 4 years since change because of those $400 components. So find it, calculate it, comment on this, explain. So on the payback method, so number 12 will be calculate how much is it, cost that you have to cover, then calculate the payback method when you have the energy saving. Then explain what the payback method is. And once you explain what the payback method is, comment on the results. Since the company doesn't have a requirement how many years to recover the initial investment, comment on those results. That's number 12. Let's go with the next one. Seeking your guidance, navigating several external challenges with possible ethical cultural consideration, including port disruption. The recent port worker strike was impacted on export, creating logistical financial strain. That's one potential U.S. tariff. That's growing concern over the possible 25 custom duty on the Canadian timber export to U.S. While Canadian currently does not impose tariff on the imported U.S. Logs, there's a hope that reciprocal action might be involved. However, 25% tariff on the Canadian pulp export to the U.S. is already in place, which adds further uncertainty given the logs serve as a key input of pulp industry. Regulatory and stakeholders collaboration, uncertainty surrounding the fiber supply requires ongoing engagement with the government agency, indigenous community, industry stakeholders to ensure sustainable and equitable resource management, that we can draw some ethical problems. And old-grown forest protection movement, increased environmental activism and regulatory pressures are affecting industry, with some logging companies recently facing bankruptcy due to the changing policy and market conditions. That's another thing that you can consider potential control consideration. So the company faces several financial and strategic decisions that will shape the future growth sustainability. As a consultant, you are asked to analyze the financial position, evaluating break-even points, assessing the financial portion, options, determining the feasibility to propose investment, providing insight, internal control, risk management, and ethical consideration related to the expansion, industry changes, among others. Using the financial data provided, include the balance sheet, you will develop recommendation, prepare financial analysis. While necessary, you to encourage to make a reasonable assumption and justify them in your analysis. So, from the last part here, what you have to do on each of those 1, 2, 3, 4, make a full discussion of possible ethical or cultural consideration. You choose one of them, and if you see both of them, comment on both of them. Identify the problem, comment on the problem, discuss the problem, and that's where it is. You don't have to provide any conclusion. You can provide, if you want to provide conclusion should be oriented on the impact on the company. That's all. What will be the possible impact on the company? That will be number 13 for you. So now, what else you have to do in the very beginning, very beginning? I want you to start with the company, what the company is about, uh, what's in the what kind of businesses, who are the owners, but just basically explain the company, and then start your analytical part with all the issue that we identify. The last thing that I want you to do at the very end of the report, I want you to finish with the conclusion and recommendation. So any recommendation which are in the report through your report, I want you to repeat them again at the very end of the recommendations, and clearly state what has to be done first, what has to be done second, and that should be your report. So it looks like a straightforward. There's no complications here. So please start working on this. Again, start with the briefly explanation of the company situation at the moment, and then start your analysis. 1, 2, 3, 4, and all the way to the very last item that you have to discuss. That will be your case 1.